So it's a real pleasure to have all of you here. Thank you for taking the time to listen to us. I was actually very interested by that outcome of the question, because if you think about it, the last couple of months, if anything, prospects for a more peaceful outcome to the China-US trade talks have probably gone up. We have gotten collectively, I think, less worried about a disruptive outcome. And yet, if you think about the backdrop to the discussion that we're about to have, the IMF has just downgraded its growth forecast for this year, and there is kind of a mood of worry about this meeting and the spring meeting. So I think that's kind of where I want to start. And basically, the unique thing about this panel, and one thing that I'm just incredibly proud to have all my friends and experts here on the panel, is these are people who have been in policy, that are in markets, and so the combination of policy insight and trading and looking at how things behave is kind of unique. And so when you're thinking about what questions to pose to the panel, I can look at them on my iPad. Then please feel free to, all questions are game, and this is a very seasoned panel with lots of market insight. So maybe we can just start with the global growth thing. The IMF has obviously downgraded growth this year 20 basis points globally to 3.3%. There's pockets of weakness all over the place. Angel, maybe we can start with you, and you can just tell us, you personally and for your investment firm, when you look out at the global economy, how worried are you?
I think the right word to use is moderation rather than slowdown, right? We come from 2017, that was a year that probably will not be repeated in a long time because everything was right. And then we had some normalization, if you want to call it like that, last year, and a continuation of that into the last quarter of 2018. I'm not particularly worried. In fact, I think the alternative headline to the IMF wheel would have been the IMF predicts an acceleration of growth next year. Because at the end of the day, what we got is a slowdown in average growth for this year due to the slowdown of the last part of last year at the beginning of this year, but then is expecting a sort of pseudo V-shaped recovery in the second half and into next year. So I think the conditions are for growth to continue to be at a decent pace.
And if I can just follow up, you obviously follow Europe very closely. A lot of the focus around the weak global growth picture has been on Europe and Germany specifically. How worried are you about that?
So Europe is weaker in the big picture, but there are idiosyncratic issues, right? I mean, and you, Robin, have made this very clear. Turkey and Brexit have been a significant negative factor for Germany. In addition to some other idiosyncratic factors, there is the yellow vest, there are the issues in Italy. So the euro area is weaker than other parts of the world, but that doesn't mean that we are going into a recession.
Claire, let me put the same question to you. So you've managed lots of different portfolios and emerging market assets. And for you as a financial market participant, what does the world feel like? I'm kind of surprised how bearish people are. We've got a dovish Fed. China, US seems to be relatively benign, and yet everyone's worried.
Yes, certainly many things have happened, especially on March 7th when the ECB came out signaling this drastic slowdown of European growth, and also on March 21st with the FOMC. And people wonder, what do they know, these central bankers, that we don't know? But I would echo the previous comments. I think that actually it might be a relatively contained slowdown, a relatively sweet spot, because if anything, financial conditions should not be too volatile. We will not have the type of tightening of monetary policy that pushed us in this taper tantrum of 2013. When it comes to also the European pool of EM exports, that has been structurally fading over the years anyway, because emerging markets are switching from good or exports-driven economies to much more exports of services and, of course, also domestic consumption. And for that matter, China, I should say, matters much more. And finally, as we know, we've seen Europe in 2011-12, in the midst of the banking and fiscal crisis, actually functioning best in crisis. So here it's quite messy, but we'll see what stems out of the European elections also in May.
Yep, that's a key event that many people are focused on. Let's pivot a bit to the U.S. We've had a remarkable dovish Fed shift, as Claire said. That's good for financial conditions. We've got them being quite supportive for growth. And yet, the world is full of yield curve inversionists who are predicting imminent recession and are quite worried about that. So what should we be worried about? We're obviously on the tail end of a big fiscal stimulus that was late cycle. There's all kinds of things that potentially you can worry about. Christopher, do you want to give us your take on the U.S.?
I just had a thought about whether you could make any money selling bumper stickers that say, "I'm a yield curve inversionist."
I'll buy one.
If this group isn't buying it, I'm probably not going to get very far. But I think to go back to your earlier point, the data is good, and yet it still feels a little nerve-wracking. And I think part of that has to do with the fact that we're about to set a record in terms of U.S. expansion. And those of us who have been in and out of markets over the years, I think we're paid to be contrarians and paid to look at cycles and paid to sort of worry about what's around the corner. I think if you do look at the current cycle, things still look pretty good because of all the things that Claire and Angel have mentioned. What I think is particularly difficult, though, is to see beyond this cycle and to look at some of the monetary, political, and technological changes that are going to be features of the next cycle. So if you're sort of planning right now what you're going to invest in, you've got to think about a world where central banks aren't going to go back to their corners anymore. They're going to be big players in providing liquidity to major economies around the world. You've got technological changes you heard from the previous panel that are changing business models throughout. And then you've got the politics that I think you're alluding to in the US. How is the U.S. political situation in particular going to shape fiscal policy going forward? We don't have the traditional, our parties don't stand for what they used to stand for. And so it's hard to imagine a new government coming in the United States and tightening fiscal policy, which I think is encouraging over the long term. But the use of the tax cuts on the part of companies to sort of take that and reinvest in greater productivity, we haven't seen yet. So I think that's where I'm keeping my eyes focused.
Got it. Dilip, what do you think? You've obviously traded interest rates, you've been in policy jobs, you are working at a hedge fund now. What's your take on the U.S.? How worried are you?
Yeah, I actually see a super extended cycle in the U.S. with the chance of acceleration. First of all, it's very hard for me to get too nervous about the underlying trajectory of the U.S. when I look at consumer fundamentals. Labor income is above 5%, the savings rate's above 6%, credit is plentiful, net worth is at a record level, confidence is high. You can get 1.5 percentage points of consumption without any heroics. Investment looks fine to me too. The fundamentals are telling you that. Nominal growth is well above the cost of capital. A lot of the biggest policy uncertainties are receding. Financial conditions have retraced. So that's about 0.5% as well. And then, small positive from housing, small positive from fiscal, small drag from net trade. It's a 2% underlying economy. And then you've got the Fed, for its own reasons, shifting towards a more explicitly reflationary framework. And then, not by its own choice, you have the White House, which is very likely to push the Fed to take out more insurance against downside growth risks, and maybe even push for acceleration in the cycle. And then finally, fiscal, and Christopher alluded to it. I've never seen deficits matter less in this town.
Yeah,
and
amazing.
While we have a bit of a risk this year with budget caps, I think going into next year and beyond, that could very well flip. If we get a second-term Trump presidency, it's not at all far-fetched to see him test the limits of pro-cyclical policy, particularly if he has a pliant Fed. So I think the yield curve's wrong, and although I don't love the policy mix, I actually don't like the policy mix at all that's coming out of the U.S., I think it makes for an acceleration in the cycle.
So that's kind of consistent with this disconnect between where we see fundamentals and I think some of the discussion that we started on the panel, some of the pervasive bearishness that's out there. Let's pivot to central banks and start with the Fed. Tanya, you've been in the markets for many years, many interesting years. The dovish Fed shift, right? Last year, this panel, the last question that we discussed was the elephant in the room, the president and the Fed. And I think we have seen lots come to pass in the 12 months since then that have been kind of a surprise. This dovish Fed shift that you've seen when you're sitting behind the screens and looking at the markets at high frequency, what are you surprised about? Did it take you by surprise? And when you try and map it into the data versus reaction function versus all the politics, where do you come out?
Well, this is going to be an easy shift for me because Robin asked us to disagree to make this more fun. And it's going to be easy because I think I'm the bearish panelist here.
Okay, good.
I'm definitely on the bearish camp, certainly compared to all the remarks we've heard here. So before I continue, just want to say that these views are my own and not of my fund. My compliance department was very adamant that I mentioned that. My expertise is in emerging markets. I'm not a Fed watcher, but of course I watch it closely because it's relevant for us. I'm not surprised because I think that there are good reasons for the Fed to be patient. I am worried about global growth. We have seen a deterioration in growth beyond expectations. If you look at the surprise indices, and you can pick your favorite one, I like the UBS one, the HSBC, whatever, they have consistently surprised on the growth side to the downside, both on growth and on inflation, and that includes the US. So I do think that there was genuine reasons for the US to be more patient. Of course, you could think about the political pressures and so on, but outside that, in the data, there are very good reasons for the Fed to be more patient. And globally, there are very good reasons to be more concerned. You see trade data deteriorating, not only on the goods that are subject to tariffs and problems between the US and China, but more broadly speaking, the trade numbers have plummeted. You look at the 20-day Korean export data, that has multi-year lows. There's plenty of evidence that we have seen trade numbers suffer. We have seen surprises on PMI data. We have seen momentum indicators that we track for all emerging markets plummet down this year. So I think there's plenty of reasons for concern. Now, of course, we have seen, as you mentioned, better signs of agreement in trade between the US and China, and we have seen China step back from its deleveraging campaign and its environmental concerns and full on in stimulus again. So that's showing some green shoots that we've just seen, and we may see a pickup in the data for a couple of months. But the ability for China to reflate the world is a lot more limited right now. They have limits on their ability to have the private sector take in more investments. They've seen plenty of defaults there. We're reluctant to lend to the private sector as heavily as they did before. Some of these new loans are going to pay back debt. That's also a problem that they're trying to avoid by earmarking new lending. And a lot of the new loans are going to the public sector that are investing in things like parks and so on that are not as profitable. So I think China is doing its best effort. We're going to see the data pick up, but I think the strength of the China pickup and its ability to spill over into global growth is now a lot more limited. And yes, the Fed has shifted more dovish, I think justifiably so. But the Fed is not yet easing. It's at best neutral, and whatever you want to think about the balance sheet, it could be even marginally tightening. I believe the balance sheet matters. Not everybody agrees, but it's not yet easing. It's just not hiking anymore. So if you have global growth slowing and a Fed that has just paused, we are not in a Goldilocks scenario, in my view.
Yep. So I think Tanya put her finger on it when I talk to people who are kind of worried about the global economy and bearish. Usually the nexus is China, and some of the data that you mentioned, for example, Korean export data and so forth, fit that picture. And some of the China bears that I speak to, are big picture concerned about. We had WTO accession. It helped generate a big positive growth environment for 2 decades. We had leveraging up, and both of those engines basically have run out of steam. And so it's a bearish backdrop. But
and also the uncertainty that all this environment has created, because
Yes.
we know that the uncertainty on trade has effects on investment and
Yep.
on growth. I was just at a panel with David Weinstein from Columbia University, and they have some studies where, for example, China, below the WTO accession,
Yep.
had the tariffs at the same level after the formal accession happened. But because the uncertainty was lingering, the actual trade didn't pick up until after it was formally accepted in.
Right. The question that I want to come back to is central bank independence. Do we, we've done 10 years of extraordinary stuff, and not surprisingly, central banks have been politicized in ways that are kind of unprecedented, right? And the Fed certainly has had its share of that. Antje, maybe do you want to help us understand and see how much weight you put on this shift? Is it just a general rethink? We obviously have a strategic review from the Fed this year that's going to get underway. Maybe you can give us your 2 cents on the shift at the Fed and how much of it coincides with politics that are more complicated.
I think the Fed, it coincides with politics, but I don't think it's affected by it, right? You can explain the Fed simply with 2 factors. The first one is, the balance of risk around global growth has shifted, as we are discussing here. And so the Fed has moved into sort of risk management mode. And the second factor, and I think is more important, right? All central banks have been making an assumption over the last few years that if you lower the unemployment rate low enough, wage growth will pick up, and then inflation will pick up. So the first part of that argument has happened. The unemployment rate has come down, wage growth has picked up,
Right.
but there has not been passed through into inflation. And so I think what has happened is that in the last few months, the Fed and other central banks have realized that the second part of the argument is not operating as they expected to operate. And so that gives them more room to give growth a chance, which is a key reason why I also agree with Dalip and most of our panelists here that this expansion can be still alive for several years, because monetary policy has the luxury to be able to accompany growth rather than having to slow down growth because of inflation.
And when you look at, you obviously are a close watcher of the ECB as well, and the ECB's QE program and other easing programs have been very politicized as well and unpopular in certain Eurozone countries. When you look at the ECB and the political backdrop and the recent discussion around tiering, and this is a question for everybody, by the way, is this tiering discussion a symptom of a central bank that's struggling to maintain the easing that's just the status quo? Or lots of people are debating whether this tiering discussion is perhaps a way to take depot more negative? Like, is it a way for the ECB to provide more accommodation? Where do you come down on that? And the politics around the ECB?
I think the tiering discussion is a way of making the framework of monetary policy sustainable over the medium run. In other words, in a scenario in which inflation doesn't pick up, you are going to have to keep rates on hold, at least on hold, if not lower, for a long period of time.
Yep.
And I think the fact we are having the discussion about tiering reflects the fact that the ECB is starting to consider that maybe the next step is not necessarily going to be a lift-off, but it could be communicating with markets that they have to keep rates on hold for a long period of time in order to have enough stimulus in the economy.
Gotcha. You phrased it a nice way, right? We've had all this extraordinary easing, and in a way, the price inflation response just hasn't been what we had thought and what textbooks had told us. Rich Clarida said that the Phillips curve is not dead, but it's pretty darn flat. And so that's a struggle for policymakers who are operating under that paradigm. So, when you think back to the discussion a year ago, it's so different, right? A year ago, we had this fiscal stimulus. It was late cycle. There was lots of focus on that. There was focus on overheating in the United States economy. We had a couple of spikes in U.S. interest rates, if you remember, in February and then later in the year. So where are we on the inflation, monetary policy nexus, and the overheating, is that all just gone? Christopher, can you help us out with that?
I think it's amazing. I think if you look back at expectations, even in October or certainly September of last year, market was pricing in 2 or 3 hikes this year. And now we've gone, obviously, in the other direction altogether. So I think things can shift very quickly. I think the economic data currently is very mixed, but it's not at all clear to me that it's all headed down. I mean, I think because we've seen reaction both by monetary authorities and fiscal authorities are not tightening, my expectation is that things will, as I said, improve from here. I just wanted to get back to your earlier point about politicization of central banks. Because I think while politicians have tried to politicize them, I'm not sure most market participants view them as being political animals. And at least so far in the United States, nobody really believes that the Fed has turned dovish because of anything the president has said. I'm not sure, ever since Mario Draghi, famously said he would do whatever it takes. I mean, I think that was a very important step for the ECB as an institution to weather a lot more criticism, and particularly in the face of a world with no inflation, and it gives them a lot more space to do what central banks are meant to do. Obviously, there are risks ahead, and that could change in the years ahead, but I think we should feel good as investors that our central banks have been doing what we think generally they ought to be doing. The trick is, what do they do from here? There is no sign that they can go back to their corners, as I said before. There is no sign that they can withdraw because of all of these other headwinds we have to growth. They're, we're depending increasingly on them.
So when you think about what the market is discounting now, so we have a cut more or less priced for this year and then a cut for next year. When you paint the scenario that we've got a positive impulse from central banks to the economy, activity is going to go up, but then there's this chicken and egg thing, right? So that's going to feed back into market pricing. So where do you end up on the Fed and tightening or cutting for this year?
Well, I think, going back to some of the points that Dilip made earlier, and I was supposed to be disagreeing with Dilip, but I find him congenial and convincing.
So agreeable.
Today I find him congenial and convincing. But I think you look at the data, and there are very few economic textbooks that would tell you that with this level of unemployment and this level of wage growth and these balance sheets that we have, this level of earnings growth. So earnings are down this year over last year, but our companies are still very healthy. That this is the time you would need to go, start cutting dramatically. So I think it's not just, it's a very important story what monetary policy is doing and where it's headed, but I think there are underlying demand drivers in the United States, and we're now seeing some data coming out of China that's picking up, including on the trade war, which I don't think has frankly been that important for the cyclical slowdown globally, but has been very important in China through the consumer confidence channel. So if that gets lifted, that's a positive.
Can I try to disagree a little bit? It maybe just to be provocative.
No, you were. Okay, Claire.
So I think the risk of the Fed getting politicized is greater than kind of the tone of what we've said so far. And the way I think about it is, number one, Trump has every political incentive to do so. It's his go-to alibi for why the economy is slowing back down to 2%. He has all the executive authority he needs. I mean, you can look back to what happened in the Reagan years. You had the Gang of Four political appointees overruling Volcker for a rate cut. A year later, Volcker was out as chair. We know Powell's term is over in January 2022. We know he has a couple of nominees. Even if they don't get through, I can imagine there are plenty of other loyalists who could be right behind them. And then I just don't see any serious institutional defenses the Fed could muster. The Fed is not mentioned anywhere in the Constitution. It's purely subordinate to Congress. Congress has amended the Federal Reserve Act, I think, no less than 20 times in the past 100 years, most of the time not to the liking of the Fed. I don't think the public understands the Fed very much, and what they do understand they don't like. It was polling below the IRS after the crisis. So I think we've got a problem. And while I don't think politics are influencing the Fed now, I can easily imagine in a year or two things will be very different. And we really haven't been there in recent memory. And I don't know what will happen in terms of how markets appraise risk premium on dollar assets if and when we get there. But that worries me.
I want to come back to that. That's a key thing. Claire, you wanted to jump in.
Yeah, maybe two things that, and again, what Tanya said, same thing. This is just my personal opinion, not that of my employer. So I think two things have changed, but much more outside Washington, if I may say, over the past 3 years, is this collaboration, relatively soft, between PBOC and Fed. Under the New York Fed leadership in particular, we had a Hanzo Hall early March 16, after 18 months of terrible commodity crisis, with the idea that the two central banks would coordinate. And here we are back in this debate of whether the Fed is independent from the Treasury. But let's put numbers on things here. If you take Japanese holding plus Chinese holding, it's about 2.4, 2.5 trillion of US Treasuries in the hands of these two Asian major economies. That's about what the Fed, right, has in terms of its own domestic holding of US Treasuries. So what are we talking about here about independence vis-à-vis the Treasury or vis-à-vis the White House? The real independence is vis-à-vis foreign nations, and that brings us to this idea of what is then the mandate vis-à-vis FX. And I think the second argument of what has really changed is that as we are approaching the US political cycle, and we have this divide of thoughts, there is this idea that MMT should be prolonged, and some candidates are definitely bringing this idea to the forefront. So that's one thing I want to mention. That's all.
Thank you for bringing MMT into the discussion.
Here we go.
I was waiting for this.
I also have stickers if you want to buy them.
So when people talk about central bank independence and the Fed, this shift to higher inflation, perhaps higher tolerance, one pushback is financial stability. So I'm curious where that figures in here. We obviously have the S&P, which is back essentially to the last year's highs with all kinds of geopolitical risks and complications. So the financial stability argument, how much is that being heard? I don't hear it very much out there. And then I think Dilip and Claire basically put their finger on it. The dollar, the reserve status, this exorbitant privilege that the United States has enjoyed for so long. Like, how much are we risking that with this dovish shift again and again? Is that something that you worry about, Dilip?
Yeah, I mean, I can imagine psychological tipping points, unfolding at some point even this year. In June, we're going to have the Democratic presidential candidates start to debate every month. We're going to have probably several candidates, maybe some of the leading candidates, seriously contemplating monetization of $30 to $40 trillion deficits over 10 years. Yeah. This will be happening alongside this process we've just been discussing about Trump increasingly encroaching upon the Fed to his political liking. We haven't seen that type of fiscal and monetary policy mix in a very long time.
Absolutely. Yeah.
And I think there are unpredictable thresholds ex ante for where the world begins to think differently about risk premium on dollar assets. Now, I don't think the dollar is at any risk of being displaced in the near term. There's still a lot of competitive advantages for the U.S. in terms of the depth and liquidity of financial markets, rule of law, independent judiciary. There really isn't a credible alternative, and there are lots of network effects. But, this can take a long time and then unfold very suddenly. Who knows when? Yep. But it's a gathering risk. That's how I think of it.
I would agree with that, and I just want to say that the only reason the U.S. can have the luxury of discussing things like MMT to begin with, it's because it's a reserve currency. Argentina is not discussing MMT, right?
Absolutely,
they can't.
Yep.
So if you begin to undermine the institutions, and if for some reason people begin to question the independence of the Fed, which they're not doing now, but I think there is a risk there, and I think it matters in the long term.
I agree. And I mean, personally, as someone who watches emerging markets closely, I was quite worried by, for example, after the December FOMC and press conference, the price action in the S&P, it felt to me a little bit like emerging market price action. So let's segue to emerging markets. They're obviously sort of the typical canary in the coal mine for global growth in many respects. And 2018 was a very tough year, right? It was. It started with a lot of dialogue that I hear now. Oh, Turkey, Argentina, they're idiosyncratic. These are highly specific stories. But then I didn't hear that idiosyncratic story anymore at all in August and September. Then it was just all out, oh my God, it's contagion. So the knee-jerk reaction when you've had 2018 be so bad is that 2019 should be better. So, Claire, is it going to be great?
I wish I knew the answer to this question, but maybe a couple of points. Emerging markets, ever since September 15, 2008, survived relatively okay. So we had Lehman, then we had the European banking crisis in 11-12, then we had the 13 taper tantrum, and then finally we have this commodity crisis, which started in 2015, at the end November 2014 all the way to February 16. And these massive adjustments of nominal exchange rate did not translate into banking crisis. And there are a couple of factors that helped. Lenders of last resort include the IMF and China and a few other bilateral sovereign lenders. That also helped, but also the understanding that there was a need to shift from export-driven economic models to much more domestic consumption-driven economies, and that's where the fiscal impulse has been actually quite good for emerging markets. So here, I think we are at the crossroads, and that goes back to being completely hung onto the Washington-Beijing trade negotiation, because the hedge to that not going well is a Chinese fiscal expansion, but the Chinese fiscal expansion can happen only so much while at the same time trying to contain some FX volatility, trying to contain a financial sector re-leveraging, and also trying to contain house prices, etc. So I think we'll know more in the coming month. But that's certainly a very important point. And the other thing, of course, coming back to your idiosyncratic stories,
Yep.
Unfortunately, they are back at the forefront for, I would say, a very similar reason, which is how much our domestic residents in the two countries that you mentioned, having trust in their own institutions. And that has been relatively challenged over the past few months. So if you start seeing Turkish residents and Argentines basically dollarizing or euroizing massively their wealth, that would be definitely a challenge for emerging markets, because these countries are much more systemic than idiosyncratic from that perspective.
Tanya, can you, I'm still puzzled why in many cases 2018 was so difficult for EM, right? We had Fed hikes, but they were basically priced by the time they came around. So why was it so difficult, and what does it mean for now, and who are you worried about?
Well, I think that imbalances and idiosyncratic stories in emerging markets have always been there, but they come to the forefront when you have a liquidity pinch. And if you have the combination of tighter liquidity and slowing growth, that's a very bad combination for emerging markets. And what we had towards the end of last year was both the Fed hiking, the balance sheet shrinking, and China slowing. And that combination is deadly for emerging markets. Of course, now we are seeing a reversal of that. Let's see whether the Fed is going to actually cut or not, but at least it's more dovish, and we've seen the China stimulus pick up, and so we're seeing some good signs for emerging markets. However, what I insist in is when you have growth slowing, what you need is the stimulus to catch up quicker than the slowdown in growth. If that's not the case, it's still going to be a challenging time for emerging markets, and we're still going to have these countries with imbalances in the forefront. And in the case of Argentina, we have an election this year, which is going to make it even more challenging, because even if there is liquidity, people may want to wait before jumping in until the political picture clears up. So I think there remains a lot of challenges, and as Claire was pointing out, in China, there's more challenges today to keep all those various parts of the economies that they're trying to control under control. If you think about it, and I think this is going to be very, very important, maybe not a story for this year, maybe towards the end of the year or next year, but China is trending towards a current account deficit. And once it falls into a deficit, the whole dynamic changes, because then it has two choices. It either has to play ball with the rest of the world to attract capital inflows, and that has implications for the exchange rate and for the interest rates, etc. Or it wants to squish absorption, squish demand to close the current account again. So it's going to have to change the way it does things. You can't keep exporting to a world that is slowing while incentivizing demand faster, keeping the exchange rate stable to appease the US relationships, and at the same time keep interest rates low because that won't attract capital controls, control the property market, and control capital outflows. We know the outflows are porous, and we know capital flight can happen. And if you are in a current account deficit, if you don't want to squish demand and squish growth, then you're going to need to attract those capital inflows. So I think in the balance of payments is where we're going to begin to see cracks sooner or later.
Right.
Could I just add on to that?
Please.
Because I think it may be even worse than you describe, in the sense that there's been a lot of focus on this current U.S.-China trade deal that everybody is, including in this room, optimistic about, hopeful about, believes it will settle and support growth. But I don't think anybody really believes that it's going to last. Everybody either thinks the Chinese will cheat or that the U.S. will move the goalposts. This delicate balance that China has to strike on its own in terms of its macroeconomic and financial market balances is going to take place in an increasingly acrimonious exchange with the U.S., no matter who is president, because the Democrats aren't more pro-China than our current president. As well as Europe, which I think is starting to stiffen its spine in terms of pushing back on Chinese trade practices. So I think it's going to have to do all of those things you describe in an increasingly difficult international financial set of conversations.
$200 billion of dollar inflows into China each year gives the U.S. Treasury a lot of options to sanction in the limit.
Yep.
Can I actually get back on something that Christopher said, which is basically the old way of doing business, the old arrangements, also in terms of geopolitics and security, are in many ways under extreme strain. And so some of the things that have been weighing on emerging markets, for example, Turkey discussing, for example, the purchase of Russian anti-aircraft missiles and so forth, how much is geopolitics playing into what's happening in emerging markets, quite apart from all the macro issues that are going on?
I would say a lot, but it's the kind of stuff you don't really see immediately in markets.
Yep.
So something bad happens, there's a bad exchange between Trump and Erdogan, and the market sells off a little bit and then bounces back, because none of that has impact on the current economic cycle or your current discounted cash flows. But what it is doing is it's subtly shifting the tectonic plates that future investments will be made in.
Yep.
And that's the hard thing to predict. If, I'm much more comfortable with the dollar's role over the next foreseeable 10 years, but those things are not forever, and those changes can come quickly. But that's the kind of thing that I think we have to watch for.
Got it.
And that's especially hard to price in.
Got it.
Maybe I'll take the other side of this in emphasizing what has happened on March 7th. So meaning we have no worsening of geopolitical conditions, but we have another whatever it takes draggy moment. And that day, emerging markets assets basically moved by about 2 sigma. Okay, so that means that that mattered more than potential purchases of S-400 S-400 missiles by Turkey or other countries.
Right.
So,
Can I also add, I mean, if you want to the positive story, right? You were asking, Robin, what happened last year? And I think what happened last year is that the year before was really good for emerging markets, right? So what you have had is a lot of accumulated inflows over the last 10 years going into emerging markets. And so the marginal improvement in the outlook needs to be bigger than it used to be in the past. And so investors are becoming more discriminating, and not all EM are the same. And those with a credible policy framework will benefit. And Turkey didn't have a credible policy framework, and that's what happened, for example, right?
So can I draw you out on that? And it's part of, again, a bigger discussion, and then I want to segue into risks going forward. But the Washington Consensus has, in many ways, been kind of a unifying framework for how we should think about emerging markets, what they should do. And it's been under strain. And so in a way, we have a natural experiment here. We have the IMF, the Washington Consensus at work in Argentina, and then we have Turkey, in a way, toughing it out and going it alone.
And the United States.
Exactly. So what are we
model.
learning about the effectiveness of the Washington Consensus here? Is Argentina a poster child for IMF involvement? Is it working out relative to Turkey going it alone? And then I'm interested in your views on both, given that they're so in focus. Tanya, you want to start?
Well, I think they're in very different situations. I think the problem is Argentina exacerbated their imbalances before the IMF got involved.
Right.
The IMF gets involved basically a year and a half before presidential elections. And it's very tough because, as we know, when you are spending and not reining on the fiscal, the way to get things back on track is to be more austere, and that's not good for growth. So Argentina is now contracting at so far 7%, I believe, of GDP. Yep. Inflation is still high, and the exchange rate is depreciating. Now try to win an election under those circumstances. It's going to be very hard. So it's not that, I mean, the IMF has a prescription for what a country should do to keep its macro imbalances, but outside the political cycle. Because you have a political cycle, that makes it much harder.
Yep.
Now they have to deal with doing the painful adjustment in the middle of elections when everybody knows the risk is if the elections go the wrong way, then you may actually have a default again, as they've done in the past. So the politics are playing a big role in this case, and it's for the IMF to decide how much do they want to play ball with that.
Yep. Clara, what's your take on Turkey to give the counterpoint to Argentina?
I think Turkey is definitely a different issue. The government has no more than 30% of GDP in indebtedness. It's much more vulnerability of the corporate and banking sector in particular, with about 120 billion of external debt due in the next 12 months. And there is a bit of a political volatility around it, but it's quite well identified, I would say, over the years by the market. I would say nonetheless that I think that market forces have been relatively resilient. So in other words, the market structurally is bearish Turkey, in part for political reasons, and has been caught off guard last year and the year before and the year before, right, in how asset prices have been actually relatively resilient and recovered. If you think of the dramatic adjustment that we had from a current account deficit at a pace of 60 billion a year to a slightly positive current account, it's a fantastic adjustment. Right. And that's what you want. So if anything, marginally, the vulnerability is lower. What has changed nonetheless is that there has been a significant, and especially over the past 2 weeks, dollarization or euroization by Turkish depositors of their savings.
Got it. Maybe we can do a lightning round. We're running out of time. Angela, we'll start with you. Risks. What is it that worries you the most? My boss says, what keeps you up at night? So I think that's a good way of putting it.
So over the next couple of years, this is my main worry, right? Fiscal policy is going to be the main policy to manage the business cycle. And my worry is whether we are going to do it right or wrong, to be honest. But this is really for the next 2, 3, 4 years. Nothing really for the next, the next 6 to 12 months.
Got it. Christopher.
China. And not China per se, but how the rest of the world manages China's growth, its rise, its integration into broader markets and financial institutions. And I think what we were just describing, China on its own has a lot of difficult problems it needs to manage. And it's unlikely the rest of the world will be helpful.
Got it.
I'll give you a category. Where do Trump's political incentives diverge from what's good for the economy? I can think of a foreign adventure in Iran or Venezuela, satisfying hawks in his base, beyond the willingness of Saudi to control in terms of the oil price effect. And the same is true on China. I can imagine a very short honeymoon if the deal is perceived as soft in terms of tensions flaring up again on Taiwan, on Iran sanctions waivers, on technology and so forth. So I don't think Trump has fully underwritten the next 2 years.
Got it. Tanya.
So given my concerns on growth, I worry that we may have a deleveraging episode that could result in financial instability in the few months if the liquidity easing doesn't come as fast as the slowdown in growth. And of course, on the back of China.
Claire, you can move us in a good direction or a bad direction. What you going to do?
I'm definitely not getting any sleep tonight.
So maybe it's going to be a bit pessimistic, but certainly I guess I don't sleep much for these 3 reasons. The first is global warming. We talk a lot about it, but practically speaking, we had dramatic events last year, and the UN had wanted to reach carbon emissions cuts so that we don't see this 2 degree centigrades rise within the next few years. And just over the past few years, we already had 1. So we are in a much quicker pace towards a breach of that cap. The second point, which is in a sense related to this, is refugees or displaced people. The UN estimates that we have about 70 million displaced people. It's the 1% of the 7.5 billion global population that is perhaps not talked enough about. And as we've seen, it's been quite disruptive for Turkey, and with not much fiscal help from Europeans and others. And that's something to watch. And lastly is on artificial intelligence. So I know that in the previous panel there has been a lot of excitement about this. But Jean Tirole, who is the 2014 economics Nobel laureate and visited us in Abu Dhabi mid-February, is making very clear points about the necessity of regulating artificial intelligence. So it's almost as if we need artificial intelligence in the regulatory design of artificial intelligence. But practically speaking, how are we going to do this? What about the ethical part? What about the future of labor? What about privacy rights and data ownership? What about political interference? And those questions remain completely unanswered, and that's where I think the multilateralism, just like in interdependence of monetary policies, will be key to try to find the solutions together.
Global warming, refugees, the rise of the machines. Thank you, Claire. Thanks, everyone. Give a big hand to our panel.
Thank you.